This is Trepp Wire Week in Review for week ending September 11th. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with our subject matter experts, Manus Clancy, Senior Managing Director, and Joe McBride, Head of CRE Finance. This week, the likelihood is slim that we'll have any government relief by October when Congress turns its focus to November elections. The Senate hit a dead end today when its slimmed down bill did not pass. Looking at economic data, although the August unemployment fell to 8.4%, an upside surprise, the weekly initial claims number of 884,000 points to a stall for now. U.S. business inventories declined again in July, and U.S. producer prices rose more than expected in August. Pharma company AstraZeneca paused late-stage trials for its vaccine, and Wall Street stocks are down for the fourth day with a lot of volatility. Manus, advocates are busy this week trying to get some relief passed before the end of September. It seems very unlikely at this point. Where will this impact be seen?
Well, I agree with your earlier remarks that passage of anything is unlikely. I'm not sure that anybody in Washington could even agree to put out a fire if one started on the Capitol lawn, which is unfortunate. You know, the big unknown right now is that the president put forth a couple of initiatives a few weeks ago, one which was to cut the payroll tax, and another was to boost unemployment benefits. And I really don't know where that stands. After it was announced, there wasn't a lot of data or follow through from the states about who was going to take that. And even if it was to be enacted through the IRS, I keep asking my daughters who make short of what is necessary to qualify for the payroll tax deduction each week if they got more money in their paycheck, and they always say no. So I take that to mean they have yet to push this stimulus through. This week, the president added more fuel to the fire by saying he was going to do bailouts for the airlines as well. So on the one hand, if he has the power to do some of these things, it does render Congress not that important in the whole process. If he can't, then we're back to square one. And I think for anybody watching the economy and watching these maneuvers, it's really hard to know what's going to be permissible and what will be blocked by lawsuit or administrative blockades.
Well, if the CDC can tell me not to evict a tenant, then I think probably the president can do almost anything at this point. It seems like all rules are out the window when in terms of bailing out the economy, right? I mean, we've talked about this for many, many weeks. The amount of stimulus from the Fed and then from fiscal policy before, when they actually did pass the bill, is kind of, I hate to use this word. I hate this word, because I've heard it about 10,000 times since March. It's unprecedented, the level of, stimulus that has come to basically thwart off a Great Depression. So there is an element of like, good on you, right? Like they thwarted off a Great Depression, but I'm not sure if this is I think it's a bad thing, probably long term, right? Inflating the debt, potentially leading to real, actual, serious inflation, right? Devaluing the dollar, all of those things. And the moral hazard of, I'm just going to go cowboy in my Robinhood account because they're never going to let stocks go down.
It's interesting to watch the dynamic right now because you see a lot of hand wringing coming out of representatives in the House and the Senate about the need for stimulus, but for the fact that they can't agree on the size and whom to target and so forth. But that doesn't seem to be trickling down to Main Street, that you would think at this point, with benefits having run out now 6 weeks ago, that there would be people marching on their state capitals or in Washington or other places to demand action And there isn't that. And it's hard to know if that's because people think it's forthcoming because the president has told them so, or if the earlier stimulus is combined with the fact that things are starting to reopen is enough to keep people from panicking about their income and making rent payments, paying for food and so forth. And it just goes back to that theme we've mentioned over and over and over again since March, which is the opacity of what's happening here, right? And it's just very hard to know what what's really happening to the economy given all of the stimulus, the future promises of stimulus, and so forth.
Right. Eviction moratoria, right? Foreclosure moratorium, stimulus, that whole thing.
People who have taken advantage of the PPP already, right? To pay their employees. So there's a lot going on here. And at some point, an economist will write a great book about this and really connect all the dots. But I feel like that's 5 to 10 years away. And in the meantime, we're trying to figure out what's happening by anecdote, which is never a great way to either manage an economy or produce a podcast.
Well, well, we did see, I forget when it was right after the stimulus was passed though. And it was March or April where incomes were actually up, like total consumer incomes were up because people were making more money on unemployment and due to the extra $1,200 than they were in their job. I have to give a shout out to another podcast that I listen to. It's that guy Downtown Josh Brown. He's very good. He's mostly anecdote and some data. So
it can work.
So right. So his co-host basically came up with this thing and he said there's 3 types of people in this COVID economy, right? Type 1, it's like, grateful, right? Type 1 is us, right? We haven't really been affected economically by this, right? Because the company is, can work from home and we can do our jobs from home and so on, right? Type 2 is the people who've been really hurt, right? The service industry workers, the people who work in stores and hotels and everything else that have been shut down. And then type 3 are the people who've never seen anything like this on the upside, right? Which is boat salesmen, right? Backyard deck construction guys, right?
RVs.
Zoom shareholders, RV salesmen, right?
Tent
all
makers,
of these things. Golf courses,
Outdoor tent providers.
Oh, outdoor tent providers are unbelievable. I have a guy that I play golf with who he does that on the side, and he hasn't played golf with us all summer because he's just been putting up tents outside restaurants all summer. So, Trex deck, like all that type of thing, like because there is another side of the economy right now which is booming, right? So, but anyway, we digress.
What category is the guy? What category is the guy whose kids have come home, taken over the recliner and the remote, and have watched reality shows in perpetuity for the last 4 months? What category is that?
We're actually going to cover that.
Yes, we'll get to that.
We get to that. So let's move on to some of the retail news or a number of stories that came across the wire that we published, Manus.
Well, the big one was the JCPenney story, which has been evolving for quite some time. Readers of Trepp Wire and listeners to the podcast and anybody who follows retail knows that JCPenney announced that they were filing for bankruptcy in May. Around that time, they announced that they'd be closing about 150 stores. There were many different firms that were circling JCPenney. Some were lenders who had provided either debtor in possession lending or had been existing debt holders of loans that found their way into the CLO market. 2 of the bidders had been Simon and Brookfield jointly, 2 mall owners. Another had been Hudson Bay, who also owns Saks, and then the lenders themselves. Those were said to be the 3 that were really circling for the last 2 or 3 months. About 2 weeks ago, a spokesman for JCPenney had come out and said that it looked like the lenders were in the driver's seat, that the other bids had stalled, the landlords and Hudson Bay. And at that point, it seemed like that had momentum. but just earlier this week, it came out that Simon and Brookfield had agreed to buy the retailer. We believe, based on news reports, that this will bump up the number of store closings from the 150 we've already seen up to perhaps 200. The two store operators, Simon and Brookfield, will be contributing $300 million in cash. There will be $500 million in new debt, from what I understand, and the terms value JCPenney at about $1.7 billion overall. So there'll be some assumption of existing debt, it sounds like. So why does this make sense for Simon and Brookfield? We talked about this with our colleague Lonnie Henry a couple of weeks ago on the podcast, and he pointed out that keeping JCPenney operating at these malls keeps Simon and Brookfield from suffering the fate of co-tenancy clauses. If the anchor were to close, then some of the inline stores would be either permitted to close or to cut their rent or to switch to a percentage of sales rent. He speculated that this had a lot to do with the reason that those two mall operators were busy and were bidding, and that makes a lot of sense. For CMBS investors, what's the takeaway from this? On the positive side, you would think that any Simon and Brookfield mall that has a JCPenney, the store is probably immune from closing, which is terrific. On the downside, and we haven't looked at this yet, for malls that have a JCPenney that operate in the same markets as a Simon or Brookfield mall, you would think that those would be at real high risk of being the next round of closings. I don't know how many there are of those, but that's where I think that they're starting their pruning.
What else do you have on retail, Manus?
Well, we saw several renewed store closing announcements. GameStop this week, 400 new store closings.
Oh, that's so sad. As someone who actually played video games that you had to buy in cartridges or CDs, that is a very sad thing to hear.
I never really understood that business model, to be honest, but then again, I was never a video game player. I was more of Miss Pac-Man, and I love the bubble hockey, right? That was my thing back in the day. You come in with a roll of quarters with your buddies after dinner in the college cafeteria, and you'd play bubble hockey for 45 minutes on your parents' dime.
Well, GameStop was kind of like, I was never really that huge of a gamer, but there was that kind of comic book store aspect to it. Like there'd be kids hanging out in there, talking to each other, drinking soda pop, trading video games. I could play my Madden 2001 for, 3 months and then go sell it for $15 and buy a new game, that type of thing. So there was that kind of, if anyone's from the Yonkers area, it was like a Dragon's Den type of deal.
You trade your Pokemon cards?
I've heard that probably happened in a GameStop, but I was not a part of that.
Other store closings, American Eagle, 50 stores, Century 21, they didn't have many stores left. They had been on the ropes for a while, but they announced that they would be liquidating and closing their 13 remaining stores. And Fuddruckers, which was always a popular destination after kids travel hockey, right? Everybody pile into the Suburban and head over to Fuddruckers and get that burger and vanilla shake and really wire the kids up. Just when you think that they're ready for their nap, you give them 2,400 calories, including 60 grams of sugar, and see what happens.
Right next to the shenanigans. So I saw something this week from Wall Street Journal. About New York City retail vacancies, and it was specifically, they did a study along Broadway, and they said more than 300 storefronts along Broadway are vacant, a 78% increase from 3 years ago, a recent survey found. They counted 335 street level vacancies in late August when they inventoried storefronts along the avenue that spans about 13 miles and 244 blocks between, the financial district all the way up to Inwood. One of the quotes was, "The rent is so high, particularly on Broadway in Manhattan, it's hard for small shops to make a go of it. At this point, with the gates down, and sometimes plywood on the storefront. You don't know whether it's going to be rented. So I think there was already high street retail stress. You know, we see it every day. Well, not anymore, but we used to see it on Fifth Avenue, right? There's the per square foot rent that you have to pay is so high that you really have to be making a ton of money there, or it has to be a flagship store that you're okay taking a loss on because you're J. Crew or Apple or something else, where I'm sure Apple doesn't take a loss, but one of those where you think, you know, I have a flagship store on Fifth Avenue and it's kind of a branding thing more than a moneymaker. Oh, and restaurants in New York City can reopen indoor dining at 25% capacity on September 30th. So just enough indoor capacity to go bankrupt slightly slower, because I don't think any restaurant can live on 25%.
Well, the irony
capacity.
there was the announcement came only 2 or 3 days after a group of restaurateurs had sued the city of New York and the state of New York $2 billion for their treatment during the COVID process. So I imagine there was some things going hand in hand with that decision,
Right.
especially considering how on the ropes New York and New York City's finances seem to be at the moment.
Well, you have, like, I saw winter is coming, right? Not to be all Valar Margulis on you, but winter is coming and you can't do outdoor dining in the winter.
You should tell
Portable
your tent
heaters.
guy to get into the
heater game.
you know, outdoor heating lamp thing.
Exactly. Portable
Yes.
heaters. Yes. So a quick trip overseas and some of the retail headlines from our friend Vivek. Joe.
Yeah, so there was an interesting blog, I guess you would say, out of the retailgazette.co.uk, which talked about the UK government actually providing retailers with specialists and consultants in online retailing. I think partly the aim is to help out retailers who have been struggling due to COVID, and also to increase exports. They're also, you know, trying to provide them with some new opportunities that have come from trade deals, basically post-Brexit trade deals with US, Japan, New Zealand, Australia, and so on. So nothing like a man in a dark suit from the government coming to tell you how to run your business. So that should be interesting. Another one, again, kind of along the same vein as last week, with Vivek, our correspondent in the UK. Iceland, Britain's favorite freezer grocer, has created 3,000 new jobs as a result of a surge in online orders. Actually, that makes a lot of sense. I need one of those for my garage because we have so much food coming in all the time, and we're eating all of our meals at home, right? So, like, you know, having an Italian wife means you have a lot of food in the freezer. Let's just put it that way. It doesn't surprise me that, you know, the Butcher Boxes of the world and the Icelands of the world are doing well. I think there was something on Prêt à Manger. Oh, they've introduced a subscription service, €20, or is that pounds? 20 pounds a month for unlimited coffees. Now, that is, you know, combining two of the most kind of high value things in the world, right? One is coffee and the other is recurring subscription revenue. So they've introduced coffee as a service here. So
if they deliver, I'm in.
That's what I was wondering. I wonder if they can do croissant as a service for Manus.
I think they should export their Premier League teams to places where they can have fans, right? Didn't New Zealand have extraordinary low numbers of COVID cases? So you could put the whole team on a plane to New Zealand where people will really value seeing Tottenham or Chelsea, and, you know, get 75,000 screaming fans and recover some of that missing loot. Yeah, missing loot from having no attendance.
I think that could fix their trade deficit pretty quickly.
Send half the teams to New Zealand and the other half to South Dakota.
You gotta bring a lot more people into South Dakota to fill up the stands, though.
That's true.
Let's look at multifamily. A number of data points released this week call attention to potential problems, especially in coastal cities like New York, San Francisco, but it seems some especially bad stats for New York. Joe, what is going on there?
Yeah, so there are a few REITs that specialize in multifamily, and a few of them that are more in the larger, denser cities. There was another article that was talking about how the broader market is still fairly bearish on these multifamily REITs. A couple of data points from the article here. In New York, asking rents for apartments owned by publicly traded landlords have fallen about 15% since August of last year. That's according to Green Street. Asking rents in the Bay Area actually fell 9% through July, and 6% in the Bay Area suburbs. In the Sun Belt suburbs, such as those around Atlanta, Dallas, and Orlando, rent growth was flat or positive. So that's fairly reasonable to understand. I think we've been talking about that. I also saw, if I can just pull it up here, this was a separate story, but it was out of Douglas Elliman. It's a big property manager in New York. They showed that Manhattan apartment inventory. So I believe this is, yes, rental listings. So apartment inventory for rent has increased almost 200% since the beginning of the year. The vacancy rate is at a new high of 5.1%. So I do know, I've been reading about some of these rent regulation and rent control laws that actually some rent stabilization rules actually go away, or they get relaxed or something. I don't know all the details, so don't quote me. But in New York City, if the vacancy rate increases, I think past 5%, then some of those rules actually get relaxed. So that would be kind of an interesting outcome from all this, that there's so much vacancy, that some of these rules that came about back in like post World War II, when there weren't enough apartment buildings for all the soldiers returning home, that they had to put these rent stabilization rules in place. Be interesting to see, almost 100 years later, a pandemic causing rent regulations to be relaxed. Although I doubt politically they'd ever let that happen.
Anecdotally, we run through property sales every single day here, looking for properties that touch CMBS, to look for pricing comps, per square foot comps, and so forth. And just anecdotally, from my perusing of these stories every day, there has been absolutely no slowdown in property sales in the Southwest, the Southeast, areas that you talked about momentarily ago, Joe, that have had flat revenue growth. Those are in such high demand right now. We're seeing them all come through with very healthy sales prices, healthy, in terms of dollars per unit, big premiums over where they last traded maybe 4 or 5 years ago. The fact that the 10-year Treasury is at 70 basis points right now, and people can buy these things at cap rates that are multiples of that, in places where COVID has not been terribly impactful, and the likelihood of people leaving en masse, like you have in New York or Chicago or San Francisco, is limited. Those just remain really, really popular markets. Elsewhere in our delinquency numbers, we've talked about this before, really no meaningful uptick in multifamily delinquencies at this point. And anecdotally, even in New York, we saw a huge solo portfolio, about $300 million in existing CMBS loans backed by 4 Upper East Side apartments get paid off this month. So even in New York, there's a bid out there for multifamily at this point. It's a vastly different story than what we're seeing in hotels and retail, even in weak markets.
And yet this week we saw the Pew Research put out a survey that said an alarming 52% of young adults, that's not all of us on this call, by the way, they're aged 18 to 34. They're living with their parents, and that is the highest number ever. The previous high was in 1940 at 48%. So somehow that will have to impact the rental market.
I think that the Federal Reserve's mandate should be changed from pursuing maximum employment and maintaining inflation. It should be changed to pursuing 10% kids living with their parents percent. Like, if you fix that issue, you've fixed every other issue, right?
Right. That's a great indicator that there are no problems if 90% of the kids are moving out of the home. But it brings me to a story that I thought I had seen the last of. One of my big gripes when I had a lot of kids in the house was the sheer number of plastic tubes on the floor of the shower that all looked alike, right? So, every kid had like their conditioner, they had their shampoo, right? There was something for the dog down there. And everything is just written in such small letters that you pick it up and you look at it. I mean,
It's dark in there.
I don't bring my reading glasses into the shower. I don't think anybody does, right? So I'm looking at this, trying to figure out, is this for the dog? Is this,
Body
is this
wash.
conditioner, body wash? For a long time, I got the Johnson's baby shampoo because you knew what it looked like. It had that tan color. It was gentle on your hair. You could use it every day. It was just one of those things. But then I let it lapse because there was nobody else in the house and I knew what the shampoo looked like and everything else. I need the Reader's Digest large book version. Like, I would buy the guy's shampoo that just said shampoo in like size 48 font.
Like the Acme
And right now I'm
shampoo.
back to 18 things on my floor. I have to lift up each one of them in succession. They're all white. And I'm trying to figure out which one is the shampoo. And now I know two things. Either I'm walking out of that home smelling like fresh jasmine, which is fine, or there's no chance I'm going to get a flea or a tick. It's one or the other.
Either way is not a bad thing.
No. It's
No,
you're
but
safe.
it's my pet peeve of the day.
Well, I will say that I do fall into this category of young adult, unlike the rest of you old fogies on the phone here. But I do live by myself. So it is possible. It is possible to get out of the house. Although I did stay with my parents for a couple of years after getting a real job. And that helped me out big time. So I can't really fault anybody for going back to their parents if they really have to. But, I think maybe some parents are they love their kids a little too much,
I saw two other stories on the topic. One was funny and one was quite hopeful. The hopeful one was somebody put out a list yesterday of 17 large U.S. state institutions, some of the biggest. So Alabama was on there, I think, South Carolina, University of Wisconsin, 17 in all. Penn State, I think, was on there. And they said in total, those institutions had over 11,000 positive COVID tests since people have returned over the last 30 days, yet not one hospitalization, which was room for hope that, if you apply that same kind of number, and of course, whoever put this together, I don't even know who did it. It could have been selective application of stats. I don't know. It was only 17 schools. But if you can believe the stat, it does bode well for the reopening of elementary schools, middle schools, and high schools, right? That maybe there's not that much to worry about getting these kids back. And maybe we can, start sending kids back faster and on a more regimented schedule.
And
Yeah.
on the
On that
topic,
note.
on that note, colleges across the country have been reporting a rise in cases. Many have been particular to the Greek and communal housing, not surprising. Student housing had already been under pressure before COVID. How's it faring now?
Yeah, so we actually, Catherine Liu, one of our very great analysts, research analysts, put together a quick summary of what's going on in student housing. You should check that out, Trepp Talk on our blog. I think the gist here is that if you look at all the forbearance requests in the multifamily space, student housing tends to take up a higher percentage of the forbearance requests than other types, based on how much of a percentage of the universe it is. And the other fact, which is not super surprising, is that if we look at multifamily, non-student housing multifamily delinquency rates, about 1.85%. If you look at student housing, 13%. So it goes to show you that it is a small portion of this universe because the overall multifamily delinquency rate is I forget what it is, Manus, but it's near like high ones or low twos at this point. But take a look at that. I mean, obviously, a lot of these places are going to really struggle, especially if kids get sent home. But we do have that other kind of reverse idea, right, which came out from, I think it was from somebody who we owe a shout out.
That is correct. AG from North Carolina.
So she mentioned that there is this kind of reverse idea, which is that a lot of students, even when they are relegated to online only learning, are electing to go to campus, or at least to go to the vicinity of campus, in which case you would be more than likely to be renting in a student housing complex as opposed to living in the dorms. So, who knows if, one of these large schools all of a sudden says, we need a month of virtual only learning to get this thing under control. I mean, I know of people who are talking about, if that happens, putting their kid up in a hotel for a week or two around the campus vicinity. I mean, I think if you're a hotel near a school, you should immediately offer your services as a COVID quarantine ward, right? And just go ahead and get yourself up to 100% occupancy relatively quickly.
Let's look at the office sector, because we had a lot of news come out of that property sector this week.
Yeah, so a bunch of articles this week, and for whatever reason, it just seems like this week was kind of the tipping point. I think maybe because kids are going back to school, honestly. And I think there's a lot of, corporations starting to think now is the time to start getting back to the office. I know that outside of the New York area, a lot of people have been going back to work and going back to the office. I know some friends already who've been going in a day or two here and there, but a couple of ones to mention. JP Morgan, I think this came out today. They told their trading floor staff that they need to come back to the office by September 21st unless they have childcare or medical issues. Another one was Goldman Sachs. They came out saying they're going to implement a rotational policy to bring more employees back into the offices. And they're going to lay out those plans in the coming days and weeks to return to their kind of regularly scheduled programming. It seems like they'll cap total attendance. I think everybody's going to do that, right? They're going to have some sort of rotational deal. I think, thinking personally, my 1.5-year-old is in daycare right now, right? And he went back yesterday. So who am I to not go back to work if I can send my 1.5-year-old back to his work? You know what I mean? So that's just my own personal thought, but I'm conflicted on it really, because I think firms like ours, and I think there's a lot of firms in the world who can operate fairly well from home. But I do think that there's something missing no matter what. No matter how well you work from home, there's something missing if you're not together. But then again, I don't mind not commuting, right? So there's kind of a push and pull to it.
And yet you look at the numbers, some of the surveys done showed that New York has one of the lowest return to work number right now at 11.8%. And when surveyed, some said only 54% say they'll return in 2021, which is astounding.
I think that's an absurdly high number. I think that I think it's pretty clear that by 2021, for sure, we were going to have a vaccine. And at that point, maybe maybe those 54%, a lot of them are saying like, well, we're not going to return to work for real full-time 100% in 2021, which is definitely true. But I think that's an astronomically high number. What do you think, Manus?
I would say that we are going to see seismic changes in terms of what people do. I think what you said, the 2 days on, 2 days off, will definitely come in, and that will result in people needing less space. There was an article today where Barclays said that they're looking to shed their space at 745 7th Avenue or 8th Avenue. It's the old Allman Brothers spot, in return for half as much space in Hudson Yards potentially. And so that was kind of a tell of what one big bank in New York is thinking. Elsewhere, we saw a story where Twitter out in San Francisco is looking to sublet about 100,000 square feet of its space. It has a big chunk of a 1.1 million square foot office in Market Street in San Francisco. That property backs a single asset deal, and they're looking to shed, it looks like about 1/8 of their space. So I think there'll be more of that. But to take a contrarian position from you on the whole office thing, when you said, you hated the commute, as somebody who once had 3 kids at the same time under the age of 2.5, the best part of my life was getting on that train Monday morning with my big cup of coffee, a New York Post, and some earphones.
Kids, if you're listening, turn it off right now. If you're listening, kids.
We do have a 9-year-old listener. You're actually shocking this child.
It was, and it was even better before iPhones, when you couldn't possibly be reached.
Yeah,
there was
just reading the Post.
I had a short commute. I had a 30-minute Metro North commute, and those 30 minutes were glorious. Just long enough to catch up on the ball scores, get a concert review, look at page 6, drink your coffee, and otherwise get ready for the day.
Well, I was talking to my wife about this and telling her the same thing, not that exact same thing, but the idea that, I firmly believe that, you have to be in person to be at 100%, let's say innovation, right? If you're building new things, if you're in an operational role, I guess, you just kind of, counting the beans or, moving stuff from one column to the other, whatever. But I don't think there are many roles like that in our kind of high tech economy anymore. I think a lot of that stuff has been automated. So if you're trying to build new things, if you're trying to come up with new ideas, I think you have to be in person more often than not. But I even mentioned that same thing. I said, right now, my commute is 2 flights of stairs. So when I come off, recording the podcast, I don't have any time to unwind. I walk downstairs and it's diaper changing, bath time, put the kid to bed, run around the street. There's no.
And that's before you even
downtime.
look at your child.
That's there's no downtime, right? So there is something to be said for the commute, but there is. I mean, I have 2.5 hours back in my day every day. So
any other office news?
Yeah, so I just there was a Newmark first half kind of leasing report that came out this week, which had a ton of data in there. So it's definitely check that out if you can get access. But the headline number here was that if you look at the average leasing activity over the last 10 years for the first half of the year, we are at about 53% of the normal first half. And this is New York, by the way, New York City, Manhattan. So normally they lease about 20 million square feet or 19.8 million square feet in the first half of the year. And this year it was at about 10.5 million. So not surprising. We've been kind of talking about that. Their first quarter report kind of showed a similar downtick. But there's a bunch of other stuff in here about there was a pretty high number of, short-term renewals inked. So I think there's a lot of corporations just kind of kicking the can a little bit before they decide what to do, if they're going to downsize or if they're going to extend long-term. But yeah, check out that report if you can get it.
And now we are going to give a few of the shout outs, and we had plenty this last week. If you listened last week and stayed through until the final segment, you heard our worst of the worst playlist as voted by the 4 of us here today. And we had some really good input from a number of people.
It was a terrific chance for people to reach out to us on things that were not educational or CRE. And we had some really great laughs out of the whole thing. And by the way, you could see that playlist on Spotify if you're interested in really getting your kids to laugh at some really bad 70s and 80s music. Andrew D. noted that any discussion of the worst lyrics ever should start with Loverboy's "Working for the Weekend." You want a piece of my heart? You better start from the start. And once I heard that, I had to agree. That had to be one of the worst lyrics of all time.
These are words of wisdom, Manus.
That was very popular during my formative years when I would sit in my MTV hypnosis in the early 80s. It was one of the first MTV songs. So I'll never really hear that song in the same way again, thanks to Andrew D. Steel City Dave said, with true authority, "We Built This City on Rock and Roll" by Jefferson Starship is the worst song of all time beyond any debate. He wanted everybody to know that it was beyond debate. MG from the Bronx, he and I go way back. He suggested, which we won't do today, but he said we should do a riff on the best live concert recordings ever. Just to remind people that at one time in America, there was live music. People went to concerts. People got to scream their lungs out. And he even gave me a list of things he wanted me to listen to. It included live cuts from Deep Purple. He's very guitar-centric. Deep Purple, Thin Lizzy, The Who, Foghat, Peter Frampton, Motorhead, and others. So look forward to that before our next 3-day weekend. We'll do our own live concert. Joe could do some Tony Bennett, maybe some Frank Sinatra. And lastly, we have Bob H., who was grateful for us for not trashing Southern rock in our worst songs ever. He is a Southern rock aficionado, and he and I are kindred spirits because I'm a big fan of old Allman Brothers recordings, posters, t-shirts, and anything else that can accompany me on a long car ride.
I saw the Allman Brothers at Jones Beach. I think I was in, sophomore year of high school. I definitely did not fully appreciate it though, because it was basically them playing their guitars for 3.5 hours with the singing for about 5 or 6 minutes of the whole thing.
Yes. Yes, that's it.
That's right up your alley.
Perfect.
We got a shout out for Jan, who liked "Who Let the Dogs Out," which was one of Keegan's favorites from last week. He also gave us a nice history of the song, which was the subject of a documentary, which we never knew about before. And I think that's it.
We have George, who wrote a comment. Actually, I think it was on our YouTube page. Not a big deal. We're multi-channel players here. He said that this is the most, now I say this, I am blushing, by the way, the most comprehensive real estate podcast ever.
Right back at you, George. Your comment is the most enlightened YouTube comment on a commercial real estate podcast ever. And there will never be another comment better than that one.
Can't lose. Can't
Amen.
lose. So now we'll move on to the deal of the week.
Deal of the week.
Got a couple of deals of the week. In the U.S., a nearly 100,000 square foot single tenant retail property in Chapel Hill, North Carolina was sold for $32 million. The sole tenant is Wegmans Supermarkets, which is very popular in the Northeast. I'm a big fan of Wegmans. Great pre-made dinners, lots of fresh fruit, and great craft beer selection. Alvin Mansour and Kevin Mansour of Marcus and Millichap's San Diego office, and Glenn Konofsky of Marcus and Millichap's New York City office, repped the seller, Leon Capital. We should point out that Chapel Hill was very hard hit by COVID news with the closing of NC State and UNC. So this is a good sign not only for that market, but for retail in general. We had noted in the past that if certain retail is going to really shine in this market, it would be grocery anchored and other things like Walmarts and Targets, and that is the case here. The buyer was a REIT, Ben Yelm, I hope I'm pronouncing that correctly, of Marcus and Millichap in North Carolina, repped the buyer, and this was reported by Connect Atlanta. So that's our U.S. deal of the week. Great to see retail getting done. Congratulations to the M&M guys and to the buyers of that property. In Europe, Allianz Real Estate acquired the two-building City Lights office complex in the Western Business District of Paris. Allianz acquired the 23-story City 1 and the 9-story City 3 buildings in that complex for 500 million euros. The properties total about 520,000 square feet, or about, drum roll please, 48,000 square meters. So congratulations on seeing an office deal getting done on the continent.
Was that Allianz or?
Did I say it incorrectly?
You said French, so I thought.
Allianz.
Allianz, perhaps. Looking at CRE from the bank perspective, our team is set to publish a report that CRE loans in bank portfolios are showing stress and signs that some borrowers are expecting to default. What are some of the highlights from that report, Joe?
Sure. So our colleague Russell has been putting together and kind of diving into the data here that we collect actually quarterly loan level performance data from a consortium of banks. And this is the Q2 2020 data. We have about 150 billion in outstanding commercial real estate balance in that consortium. And the upshot here, and I won't give it all away because there are some very interesting tidbits and connections being drawn in this report about potential for strategic default and other things like that in terms of which loans are defaulting. I think what we seem to be seeing, and we haven't done enough to really totally get down into the weeds here, but what we seem to be seeing is that larger loans have higher default rates, and loans closer to their maturities are also experiencing higher default rates. But the current default rate, or delinquency rate, I should say, is about 59 basis points in this pool. And that is a 65% increase from last quarter when it was 36 basis points. So that's a material increase. It's still a very relatively low number compared to where we were at the peak of the financial crisis, which was near 9%. I think a lot of that is due to a lot of the stimulus that's been put in place, the forbearance agreements, the active asset management of a balance sheet lender. I do think that banks in general have a lot more flexibility in terms of, extending, in terms of changing up loan documents and, again, actively asset managing these things, as opposed to CMBS where borrower misses a payment, it's reported, boom, they're delinquent, right? Bank has a lot more leeway to adjust things. So anyway, I think it would not be surprising to see that, similar type increase next month, if not more, especially given the fact that I don't think banks report loans as delinquent until they are pretty significantly past due. So anyway, that report will be coming out, so check that out when you see it.
Yeah, early next week. Manus, the last 6 months we've covered the movements week over week in the CRE finance sector. Looking forward now, what changes could we see in the market as a result of this pandemic and the flash recession?
Well, every crisis comes out of something different, it seems, and every crisis seems to come with its own set of reforms. The securitization market itself, as we talk about in our academic series, came out of the hyper interest rate spike in the late 70s when banks were holding below water mortgages on their books when short-term interest rates were twice the interest rate on their loans themselves. And that kind of spawned the first securitization wave, and then the real estate crisis of the late 80s spawned RTC, and then later CMBS. The great financial crisis ultimately gave us stress testing and risk retention and more discipline. That's not a regulatory change, just more discipline from the market. So every change happens for a different reason. I think it's fair to say that this one is unearthing problems or soft spots in the market that people will be eager to address in the future. The 9/11 attacks And by the way, we're recording this on 9/11, so let me take a brief moment to shout out. We've already shouted out other people, but I meant to do this. All those that were impacted by 9/11, who lost family members, a real hat tip to those firemen and police and first responders that not only showed up on the day that the towers were hit, but we're looking for rescue victims down in an area that really wasn't safe for people to be, and who really stood up bravely during those times. I never want to forget those, and thank you to Martha for reminding me before the call. But after 9/11, there was a review of all the terrorism insurance for commercial real estate, and we ended up having long discussions and ultimately changes in that, so that all properties had some level of protection against a terrorist event.
And there was a law passed, right, which said that it was TRIA, Terrorism Reinsurance Act, or something like that.
And it has to be reauthorized periodically, and
Right.
often it comes down to the 11th hour for it to get reauthorized. But I think now out of this, there'll be two things that come out of it. On the CMBS side, and I'm sure on the banking side and with insurance companies too, there'll be much more attention focused on business interruption insurance. Does it include pandemics? I think that you could see CMBS, the CMBS trade industry, CREFC, and others want to take on the issue of how reserves get released under unusual times. What would be the trigger for that? What pandemic and business interruption insurance should look like, how much coverage there should be. I think that some may push for a revisiting of the REMIC rules so that servicers and special servicers have more flexibility to give forbearances without Congress having to be involved to suspend rules and so forth. And I think that there may be more of a recipe that is given, that if certain things happen,
Right.
here's what a borrower can expect, and here is what the special servicer is entitled to do. I think that would help immensely the borrower experience going forward in terms of what they can expect. On the modeling side, I think that, we spent the years 2008 to 2015 with banks helping them build models that were really catered towards the type of crisis we had in 2008, a liquidity crisis, a Wall Street crisis, not a Main Street issue. I think that we will spend the next 5 years going through this taller data that Joe referred to before and coming up with new models and separate models that address things like business interruption for long periods of time. I think our modelers at banks will have years looking through trends and so forth to kind of figure out who failed, why they failed, and what exactly happened during this time frame. And it'll be a very rich data set, and it'll be very interesting for those that really want to get into the weeds.
Yeah, and just to give the 30-second overview for people who aren't in this world, the Manus talked about changes to the REMIC rules. REMIC is a real estate mortgage investment conduit. It is the kind of legal structure that a CMBS deal is, and they create it for tax reasons, right? So that it's essentially a pass-through vehicle where principal and interest payments from loans come in through the conduit, the REMIC conduit, and then get paid out to bondholders, and then the bondholders are taxed on the income, but the REMIC itself is not taxed. Now, there are some rules around maintaining a REMIC status, and I'm not a lawyer or an accountant, but one of the rules is something like it cannot be actively managed, right? It has to be a static pool, essentially. So when you start having special servicers actively changing the collateral or changing the underlying kind of economics of the loans, that can get dangerously close to what they call breaking the REMIC structure, at which point you have all sorts of crazy tax implications. So that makes sense. I think, if they pass some sort of rule that said there can be some management, but within these bounds. I think that would help a lot of people and give them a lot of clarity. Now, when you first started your talk there, Manus, you said every crisis has its reasons, or every crisis has its outcomes. I thought one song we should add to our most terrible songs list, it came to my mind right away when you said that, is by Poison, Every Rose Has Its Thorns. So I think we need to add that to our Spotify list and maybe come up with our own version of it. It's like every crisis has its outcomes.
That's a great bad song. That's just a great bad song.
But it's definitely a bad song.
So, related to that, maybe this only can happen in 2020, the year we've had, but CNBC reported today that vinyl records have outsold CDs for the first time since 1986. Manus, did you get rid of all your LPs?
Mine had gotten moldy in my basement. They had been sitting in that milk carton since the mid 80s. I almost couldn't separate them. They were so adhered to each other. So that was kind of a sad yet enjoyable walk through memory lane for me, going through both the good and the bad. There was some great stuff in there that made me want to go back to Walmart this week and actually buy a new turntable. I now see that Walmart sells vinyl, and they had great stuff in there. It was a lot of some of the best albums of all time is really what they're pushing out there. And so I'm tempted to go back there and buy one and start going old school in that regard. But as we're talking about nostalgia and crises, we'll put those two together as our last two topics. It was a crisis week for many of my contemporaries this week, and my phone was vibrating no end after the passing of Tom Seaver, which came shortly after our recording last week. That as more than one person had told me, the only way this could have been worse is if it had been Paul McCartney. Right, it's the two most nostalgic.
They don't play in the same band.
They don't play in the same band, but the number of texts I got about going to see Tom Seaver and how good he was, and what a joy he was at his craft was just bittersweet. Bittersweet. Sad to see him go, but just so many fond memories from people I hadn't heard from in a long time. So. And for Cardinal fans, they lost Lou Brock this week, who was another icon for that community.
We always have to squeak a little sports in there. So with that, we'll close. Thank you to our producer, Keegan St. Ange, who does have a turntable, by the way. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question, comment, feedback, or just want to say hello, send us an email at podcast@trepp.com. For more info, visit trepp.com and subscribe to the podcast with your favorite provider. Thank you for listening, and stay well.
All right.